The video you're about to see is an excerpt from an Entrepreneur Circle event called the £1 Million Master Plan. Now, that whole event was a complete blueprint guide on how to scale a business from wherever it is now to the elusive 7-figure mark, hence £1 Million Master Plan. And in this excerpt, you're going to discover the 6 key numbers that you must know as an entrepreneur if you want to build your business so that it's turning over at least £1 million a year. It will help you hugely to get to grips with what we call business maths in a way that I promise will not send you to sleep. I think you'll enjoy this. Business is a numbers game played by a team. And I'm going to bring Martin back up in a moment. But before I do, let's just have a little look at page 70, because this, I think, will cause a few people to furrow their brows, because I'm asking you 6 questions on page 70. And again, this is for you. We're not going to share this out. This is for you to think about. But you want to honestly and accurately score yourself out of 6 on these and look at, and when I say you're scoring them, how many of these questions do you actually know the answer to? Number 1, how much profit did you make last month? It's an interesting question. How much profit did you make? That will be February. This event's happening in March. So how much profit did you make last month? What's the monthly break even for your business? So how many sales do you need to make in a month in order to break even? What's break even for your business? It's an important number. The third question, what's your gross margin? What is your gross margin? And your bonus there is, why does that matter so much? Do you understand why your gross margin matters so much? So your gross margin will be a percentage, and it will be a percentage number. The first 2 will be pounds numbers. The third one's a percentage number. Number 4's a fascinating question for a lot of people. What's your operating cash flow so far this year? And that will be a single number, by the way. That's what it will be. It will be a single number. What's our operating cash flow so far this year? Question number 5 says, what was your cost per acquisition last month? So what did it cost you in February to bring on board the customers that you've brought on board? And then the final question, how are you tracking against plan year to date? Now, that might be calendar year, it might be financial year, it doesn't matter, but that's every business we're in the midst of a year to date. How are you tracking against your plan year to date? Now, they're not random questions, those 6 questions. I believe those 6 questions, your ability to answer those 6 questions accurately. And again, you get to choose whether you could blag this and pretend. Some of you will do very well and will know all 6. Others will be wondering what I'm talking about at this point. But I've chosen them very carefully. They're not random questions. They're not designed to catch you out. I'm not trying to trick anybody here. But those are 6 questions that are symptomatic of a professional business person. A professional business person would know or very quickly be able to access, literally in minutes, the answer to those 6 questions. And on page 71, I've put up there, the fact that it's very unlikely that you'll ever hit a 7-figure business, certainly not hit it consistently and sustainably, unless or until you know and live these 6 numbers. So this is a biggie, this page. We've never laid it out quite this way before. So I'm going to go into a little bit more depth on these now, and we'll just go through and explain it in the best way we can. And to help me, I'm going to get the guy back up that we met this morning. So we've got some music cued. The entrance needs to be dramatic because we're talking about numbers. So we need all the help we can get at 4:30 in the afternoon. We've got to keep the energy levels high. And can you bring your own workbook, please? I'm taking mine across my little stool with me. So here again is Martin Norbury. Right. Come on, Martin, come on. Well done. Okay. So, this is a difficult thing to do with a large audience, even if we were just all in the room, let alone having, again, recognising that we've got a lot of people on the live stream. But these 6 numbers, I mean, do they really matter?
Yes. Yes. You know, my least favourite business in a least favourite company in business are accountants. Mm-hmm. Sorry if there are any in the room. I do apologise. And the reason is because most businesses don't get these numbers. And they don't get these numbers because the accountants, and this is not a good thing for accountants, they charge too little because there's too many of them to get the business. And the trouble is, if you don't know these numbers, you cannot potentially set out the agenda of how to grow your business. That's just fact. And every client we ever work with in Mastermind, whether it's our own clients, the first thing we do after the terms is then say, okay, so here are your terms, and these are the numbers your business is currently doing currently. Because then we need to go, well, what does it need to do to deliver your terms? Yeah. And this is where it starts.
Yeah. So, and we're going to go through most of these elements here. I'm not going to dwell on number 1 because I think from an understanding perspective, most people will be able to grasp that. So, you know, how much profit did your business make? You ought to know that. If you are using, you know, one of the, if you're using the likes of Xero and QuickBooks, they will give you an answer to that.
There is one thing, though. A lot of people think to double the size of the business, they need to, or double the size of the profit, they need to double the size of the business.
Yes.
And hopefully what we'll show you today is actually that's further from the truth than you could possibly imagine. It's like, oh, if I need to run, you know, £2 million business to get 400,000. No, you don't. Yeah. And there's some real key reasons why that's the case.
But then the second question about break even. Let's just explore a little bit on break even, shall we? Because because break even is, in fact, let me tell what to do. Help me out. I'll just want to talk this through, and I'll hand back to Martin. You just go to page 74 for me. Now, what we've got on here is on page 74 is this chart, and it's a very simple, primitive kind of bookkeeping chart, really, is this. But then on page 75, I've broken down the different elements. So that's essentially how we build this up. But I want to make sure you understand this. So we'll go back to 74, please. Stay where we are. All right. So the way we build this up, the thick line there that moves up diagonally from the bottom left to the top right, that is because what we've got, the scale here, we've got pounds up the vertical axis, and we've got kind of output, the number of sales that you make, broadly speaking, on the horizontal axis. So the revenue line for most businesses will have that kind of shape to it. So because the more units you sell, the more revenue you will generate. So that's what that line is. So this chart starts with revenue, that bit thick line that goes right up the middle there. But then what we then got to put on there, in any business, there are fixed costs. And Martin will talk about this in a minute and elaborate on it. But a fixed cost is as it suggests, it's a cost that doesn't change. Now, in businesses, so things like your rent is a fixed cost. Most people would put in some of our utility bills as fixed costs. If you're leasing a car or a vehicle or a van, that cost will be a fixed cost. And most businesses, when they're set up, have got a level of fixed cost. And that's our dashed line, and the cost is fixed. So it doesn't change. No matter how many units we sell, the fixed costs don't change. That's why it runs across horizontally. Can you see that? Across there, yeah? Now, what that means is, and I haven't got a little pointer here, but straight away here, so if we sold nothing, so if we're right up against the zero in the left-hand line, I've got no sales whatsoever, but I have got some fixed costs, so I am going to make losses. Does that make sense? So if you can't see that, but that bit there, if we sold nothing, we're going to lose that vertical axis that's shaded in. Does that make sense there? But only we are going to start selling something, and as we start selling something, our revenue line, our thick black line, kind of kicks in. But as our thick black line kicks in, so do our variable costs, because they add on as well. So the second diagonal line that I've got running across there is what I've called our total costs. And our total cost is your fixed costs, those costs that never change, about how much you sell. But on top of those costs, when we start trading, we've got our variable costs. So if I set up my business and I open my shop, I've got my fixed costs, I've got all my rent to cover, my electricity bill to pay, and I might have my delivery van that I've got. All my fixed costs are in there. But I've then got some, if I start to sell my furniture, I sell some chairs. So when I sell the chair that Rachel is sat on, and I sell that chair for £100, but it costs me £50 to buy that chair, as well as my fixed costs, I've now got to cover the £50 to buy the chair, so my costs go up even as I'm selling. Does that make sense? So that's what my total cost line then starts, and that goes up in line with my revenue. Does that make sense? Because that will also go up from left to right. It'll be a diagonal line. So my costs, the minute I start trading and selling something, my total costs go above my fixed costs, yeah? And that line, at some point, that line will cross over my revenue line. And the point where those two lines cross, and I'll put a big circle on it in there, that's break even. That's when the business now, at that point, the business is making no money, but it's not making any losses either. It has broken even. So its income has equaled its costs. And it's a very, very important point in the business. And it's an important point, not probably for the reasons that you think. Because it's not an important point because, goodness, I can breathe now, I'm not losing money. That's not the reason why it's a really important point. And we'll explain what the important point is in a moment or two. Now then you've got the two shaded areas there, yeah? So in the left-hand side, in that little triangle, shaded triangle, I'm making losses. Now you can see that the closer I get towards break even, the smaller the loss is, yeah? And then I pass through break even and I start to make profit. But what happens to the profit the further away I get from break even? It gets bigger. But it doesn't just get bigger, it accelerates faster. The rate of growth, if I was to do this on a proper chart, this is why it's difficult in an environment like this, but that profit line, you can look at it there. If we were to break the outputs line from break even to the end of the chart, if we were to break that into 10 bits, there were 10 units that were sold there. I put 10 vertical lines in there. What you would see is that the amount of grey profit in each of those 10 lines, it gets bigger. It gets bigger the further away I get from break even. And there's a really important reason for that, and it's linked to your gross margin. Because if we go back again now, because the gross margin is in very simple terms, and I've outlined this on page 76. So because it's really important you understand this, and I'll have my go, and then I'll pause, and you can take over and fill in the gaps. All right. So the gross margin it's important you understand this. I'm trying to talk not in accountant speak, but in kind of entrepreneur speak and professional business person speak. So your gross margin is the percentage share of every sale that's left over once you've paid the costs of what you've sold to contribute towards your fixed costs, your overheads, and your profit. All right. So using my example of the chair, if I pay £50 for that chair and I sell it for £100, my gross margin is 50%, because I've had to use 50% of it to pay for the chair, but it gives me 50% left over to go towards my fixed costs, my overheads. That's another word for fixed costs, is overheads. Typically, they're the same thing. So does that make sense? And it goes towards that £50 contribution. My gross margin goes towards my fixed costs and my profits. And that's how that works through. So I'm going to make a couple of examples on page 76. So if you buy the product for £100 and sell it for £200, you've got a 50% gross margin. In other words, you've got £100 left over to contribute to your overheads and profit. Now, this is the really important thing, and we'll get into a lot of detail about this, but gross margin should include any cost that you'll need more of as your business grows. Does that make sense? So, in other words, let's think, things like marketing. And this is where, and Martin will get on his high horse here, and rightly so, because so many accountants who'll do your accounts because you're only paying them £100 a month, they've got no time to do anything. So they'll just stick your marketing, for instance, in as an overhead, and they'll treat it as a fixed cost. But it's not a fixed cost. Not for the professional business owner, because if we want to sell 2 or 3 or 4 times as much stuff, we're going to have to spend more money on marketing. Marketing's not a fixed cost at all. It is a variable cost, and therefore it will, because it will go up as we sell more stuff. Does that make sense? We had one of the biggest businesses in EC was in a circle just a couple of weeks ago. It was really interesting, and he spends just over £300,000 a month on marketing. Okay? Now, the business did 27 million last year. He's doing really well. He's very happy spending his £300,000 a month. But one other member of the group who knew the size of his business, she knew that he's at the helm of a £27 million business, but it came out in conversation that his marketing budget is over £300,000 a month. And I mean, I'm not joking. I mean, we had to resuscitate her. She could not get her head around the fact that he's spending £300,000 a month. It was just like, oh my God, I spent all that money. And because he sat there really relaxed about it, because, I mean, you do the maths. So if he spends that's £3.6 million on marketing, but he's generating £27 million of sales, I mean, he's making loads of fucking money. It's not only the biggest business, it's also very profitable. But she couldn't get her head around this. But there's no way he'd have a £27 million business if she was running it. Because he'd still be spending £500 a month and thinking that's a lot. But you can't get to 27 million. So that's why marketing is a variable cost. So it would be on, think back to me, my big chart, please. Because everyone think we're on that. That's why the marketing cost has to be on that total cost line. It's not in your fixed costs. And it's anything, the rule is anything that you will need more of in order to markedly grow should be in your variable cost. So in the example that we don't need to flick back on the chart, leave that chart up. But on page 76, I've said here, so the example midway down, if you buy the product, the chair, for £100, and I spend £40 marketing it, then my total cost line now is 140 quid there. So I've got to sell the product for £200. So my gross margin now is 30%. That makes sense? Because I've only got £60 left to contribute to my overheads, my fixed costs, and my profit. Does that make sense? But much better to have when I get my gross margin accurate, this puts me in control of my business. And what Martin will explain in a moment and tell you, and I'm going to steal his thunder and give you the answer now, because once you get beyond break even, your gross margin, on every sale you make after break even, your entire gross margin goes to profit. That's the beautiful thing about it. So if you have got a 50% gross margin, you know, and you get to a point where you get beyond break even, so you're already making money, every additional sale, half the value of that sale at a 50% gross margin goes straight to your profit. And that's why on that chart there, because that profit is getting bigger. If we were to break those 10 little segments, which I wish I'd put on the chart there, you know, this is not going to work, is it? I mean, jumping up, but I'm going to try and make sure you've got this. So I'm right underneath break even here, and I'm at the end of the chart here. If I was to break this into 10 units that I'm selling, but thank you, that's brilliant. So here, the first unit here, God, it's a bit, someone's got a very dodgy hand. What's doing that? Jesus. You see the doctor? So, look here at that extra unit there only gives us a little bit of grade, doesn't it? You see there? But down here, look how much profit that last of the 10 sales makes me. Makes me a lot of profit. Does that make sense? And this is why you don't need to double the turnover of a business to double its profits, providing it's already at break even or beyond.
the profits can grow markedly. And what they actually do, they actually grow by the extent of the gross margin, providing the gross margin has been calculated properly. I'll pause for breath and you can make that clear to everybody, please.
As he said. So I think the key thing to look at on page 76 is the words left over to contribute to your overheads and profit. So this is where businesses go fundamentally wrong, is they work really hard to try and cover their costs. That's like running really hard in a 100-meter race to stop just before the line. Yeah. Once you get your costs covered, that's when the profit really accelerates. And most businesses stop at that point, which is the most bizarre thing. So when you're building a business, when we're building the numbers that we want in the future, what we have to do is we have to say, right, how much profit do we want first? That's our number one goal. To get our terms, how much profit do we want? What are our fixed costs on top of that? And there's another thing we add on top of that is what we call your non-productive salaries. So let me explain again, because again, some accountants will say this isn't the right way of doing it. By the way, I'm not an accountant. But when you add in your costs to your business, salaries of people that are involved in sales, marketing, and or delivery have to be included in the variable cost element. Because if your business grows the revenue, guess what? The people have to grow as well. If they're in the fixed cost, they won't grow. They'll just stay there. Does that make sense? So what you've got to do is you've got to add three things to get your gross margin value in your business. You've got to add your profit, first of all. Please do that. You've got to add your overheads. And then you've got to add your non-productive salaries. Those three together, and let's just say, for example, they were 10,000, 10,000, and 10,000. Those three together give you your gross margin value, which is 30,000. If we make 50% margin and I turn over 60,000, 30 go to the cost of sale, and then 10, 10, 10 go to the bottom figures. So I still get my 10,000 profit. So you need to look in your business and say, how many of my staff would I have to grow if my revenue grew? Because the most important number in business, without a doubt, is your gross margin.
Just pause on that for a moment, because most people don't realise that. This is we're getting now into the nitty-gritty of what makes a professional business person. Because I would absolutely stand with my brother here and echo what you just said there. The single most important number in your business is your gross margin. And I don't want to embarrass anybody at all, but what I know is there is a large percentage of people with us now in the room or on the live stream that, hand on heart, do not know what their gross margin is. And so this is a really important point now in the context of this event, because I'm all about trying to make this better going forward. It doesn't matter where you're at right now, matters where we're going to go in the future. And getting a proper grasp on your gross margin is really, really critical. And it's essential. If you go back to this morning and those steps we had to take, step number 3 was formulate a plan. You can't formulate a plan to get you where you want to be if you don't understand the levers that are going to make that happen. Because going back to my chart you don't know how many units you need along there because you don't understand your gross margin. You cannot get there. And again, if I could wind the clock, there aren't many things I regret, but I do wish I'd understood this numbers bit earlier than I did. Because it would have, at worst, it would have saved me a lot of pain. And at best, it would have got me where I am a lot quicker. And I do want to work quite hard to try and get this across here today. But it's a difficult thing to do in this environment.
I think the key thing is you just got to go back and look at your numbers and say, is there anything, what we call below the line, in the fixed cost element that really should be a cost of sale, as in it grows with the revenue? And the way I sometimes do that, because accountants and people say, oh, don't ever put people because they're fixed, because you pay them salaries. Well, we pay them the salaries, but what about the new ones I need to generate the new revenue? And that's the key difference. So if you go back and say, if I 10x'd my business tomorrow, what extra heads would I need? Would I need another bookkeeper? No. Would I need a finance? No. Would I need an IT? No. But I might need delivery people. I might need sales people. I might need marketing people. And what you want to do is you want to spend as much time as you can to get to that gross margin figure. Because when you plot your business forward, say 2 or 3 years' time, to the number you absolutely want, that gross margin figure has to be right. So for our clients, for example, I go back to 2019, 2020, 21. I do the last quarter and I look at all their gross margin figures. And if it starts anywhere near like 90 or 100%, I just say, forget it. We have to re-engineer your whole accounts again because you haven't included the right level in there. And I think that's the really key part of it going forward as far as gross margin goes.
So hopefully, I'm going to keep moving because we're going to make some progress. And I'll find a way to catch up and answer any questions if we need to. I just then want to go on to break even on page 77. And I've explained what this is already. So break even is how many sales you need to generate, enough gross margin and gross profit to cover your fixed costs and your overheads. But what's great is that once you move beyond break even, all your gross margin flows through to profit. That's the bit that people don't understand. So then I've given you 2 examples here, or 3 examples. And so I've given you a little business here on page 77, which hopefully this will make sense. And so fixed cost in this business, £10,000, gross margin 50%. Average sale price is £1,000. So break even is 20 sales because 20 sales at £1,000 equals £20,000 of revenue. 50% gross margin means there's £10,000 left over to cover the overheads of £10,000. So hopefully that makes sense. That's logical. Now, if this business, though, this made-up business, is actually doing 30 sales. So they're doing 30 sales at £1,000, so they're generating £30,000 of revenue. 50% gross margin means there's £15,000 left over to cover overheads of 10. So the business is making a £5,000 profit in this instance. Now, but to rapidly grow the profitability of this business, we do not need to rapidly grow the sales. So the next example on the bottom here, if we just increase sales by 20%, so sales now go up from 30 to 36 sales. So now the £36,000 of income, 50% gross margin. So there's £18,000 left over to cover overheads of 10. So now we're making £8,000 profit. So a 20% increase in sales actually grows our profits by 60%. Now, if you are running this business and you were actually doing 30 sales, the middle one there that I've given you, and you're making £5,000 profit, and you go, oh goodness me, I really want to make £10,000 profit. I've got to double the business. Well, hang on, you don't, because let's just do it now together. So if I double the number of sales from 30 to 60, you want to write this down, come with me on page 77. So 60 sales at £1,000 is £60,000 of revenue. 50% gross margin means there'll be £30,000 left over to cover my overheads, my fixed costs of £10,000. So the business now is making a £20,000 profit. So by doubling the sales, I've actually grown my profit by 400%. It's gone fourfold from £5,000 to £20,000. That's the living, breathing proof of my angles getting as it gets bigger. Does that make sense? Because every sale beyond break even, the gross margin, which is £500 in this case, so it's 50% of £1,000, every penny of the gross margin goes straight into your profit. And this starts to open up all sorts of opportunities for businesses. And it's where we've seen, probably some of the biggest successes in Mastermind, where businesses have had, meaningful growth, double digit, 20%, 30% growth in sales. But what it's done, it's been transformational and life-changing. And Aston Martin acquiring for some businesses.
Oh, yeah, very much.
That was an in-joke, by the way. But one Mastermind member did turn up in an Aston Martin because of exactly what I've just talked about, and it wasn't Chris Blunt. Oh, look, it's me. Sorry to interrupt, but if you think this is good, you could get the full recordings of the whole event completely for free by becoming a member of Entrepreneur Circle. If you click the link in the description, and you'll see everything for yourself, because this is just the tip of the iceberg. I think you'll love it. So that's our gross margin and our break even.
But there's a real key here, because what happens is people get a little bit of profit in their business and they go, right, we're going to grow our business. And what they do is they grow it, but they grow it out of control. So they haven't got what's called a budget. and I hate to say this, we're entrepreneurs, we don't want to work with budgets, but if you want to be the professional businessman, the budget is your best clue of what you should be doing based on the numbers you are, rather than what you are doing based on the numbers you are. So if you have a budget and it says, right, okay, like we just did there, if we grew the business by another number of sales, we should be getting this 40,000, whatever the number came out, 440,000, I think you said, we should be getting that profit. And if we're not getting it, why not? And that's the key. I see too many businesses that grow and their fixed costs grow too much because they're not budgeting for it. And we'll just spend a bit here, we'll just spend a bit here, we'll just spend a bit here. And then their variable costs go up. Why is their variable cost going up? They shouldn't do. It should only go up in proportion to their revenue. So what they're doing is they double or treble their business, but their profit only doubles or trebles, which is criminal. And if you put this together and monitor it consistently, you'll actually see where you're making those mistakes on a daily, weekly, and monthly basis, and that's the key.
So hopefully what's happening now is you're starting to get a good sense of what we mean when we talk about a professional business person, because this is the difference between businesses that are being properly managed and run. I said this morning, it's about understanding and controlling the business, and that's what we are getting to now. On our 6 questions on page 70, having gone through break even and gross margin, the next one, number 4, was operating cash flow, and I talk about operating cash on page 78. So operating cash, it is a thing, by the way. It's an accountancy term. It's not, and it's very different. This is not a cash flow forecast. Operating cash, as I've tried to describe it on page 78, it's the amount of cash that your business either generates or consumes. It can't do both. It can only do one or the other in any particular period of time from normal operations. And for most businesses, you would look at operating cash on a monthly basis. You can look at it over any period you want. You can look at it on a weekly or an annual basis, but ordinarily you look at it on a monthly basis. So you'd be looking to understand, well, did we generate cash or consume cash? So in my business, what happens is the pattern for my operating cash is for 2 months in a row, I generate cash, and then in the 3rd month, I consume cash. All right, now see if you can understand and work out why that is the case. All right, don't shout out, just so I want others to think about it, because you're understanding rather than other people telling you. So why would my business generate cash in quite large amounts for 2 months and then consume cash? In other words, we spend more than comes in 1 month. Does that make sense? And then that cycle repeats. In the next 2 months, we generate cash, and then in the next month, we consume cash. And that goes on. And the answer to that, I'll tell you the answer in a moment, because cash is not about profit. Cash is fact and reality. And as I said on page 78, you count the cash at the point at which it either goes out or comes in. So you only count cash when it actually comes into or leaves your bank account. You don't count cash when you invoice, or when something's due. It's only counted as cash when things actually happen. And so cash is fact. You've either got it or you don't. So my operating cash flow is positive. In February, it was very positive. And in March, it will be very positive. But in April, I will consume cash. Okay, now's the time to tell me the reason why. VAT. That's exactly right. So, because like most businesses, I pay my VAT quarterly. And so, all the invoices go. So for 2 months we consume, but we generate, and we had interestingly, last year there were 2 months when we actually managed to generate a little bit of cash in a VAT month. So I kind of broke that cycle, but it's a difficult thing to do because obviously we're, for all of us having to pay that VAT out. But that VAT, when we collect the cash. Graciously collect it for HMRC free of charge. We don't invoice them or bill them. We gather this money in and then we send it to them on a quarterly cycle. But knowing what your operating cash is very, very important. And what I'm very particular with my finance team is to make sure that what I'm tracking is operating cash. So if I do something that is exceptional, in other words, it's not a normal part of my operations, I go to great lengths to make sure that is taken out of my operating cash flow. So, for instance, in December, I made a fairly chunky contribution to my pension because there was quite a lot of surplus cash in the business. Our year end is the end of December, and a sensible thing for me to do was to put a chunk of that money into our pension. Now that's an exceptional item. I can only do it because the business is making money and is profitable, but I don't want to show that in my operating cash flow. Does that make sense? There's an argument, well, I technically should, but I want to look my operating cash. I want the rules to be the same every month. So my operating cash is the stuff that I'm actually operating in the business. You're going to ask me a technical question, aren't you? I need a microphone down here. If we're going to ask any questions, that's interesting. There we go. It's got to be a good question now. The pressure's on.
It's my dad's stupid question, but is cash your bank balance?
Well, it's more. Well, yes, it's more than your bank balance. I mean, obviously, it's all the cash that the business has got, wherever it may be domiciled. But it's cash in the business. So cash is cash. It's a factual thing. You can't manipulate it. You either got it or you haven't got it. It either came in or didn't go in. It either went out or didn't go out. It's what you've got. So cash is your operating cash flow is the business generating cash. And this is where a number of businesses get into all sorts of bother because they're running the business. And there was someone asked a question earlier on the live stream, and the question, as I recall seeing it, was broadly that my business partner is very reluctant. How do I help my business partner to understand the difference between good debt and bad debt? Because they still don't trust me because we're repaying previous money that I've borrowed. And when we dug a little bit deeper, that money was borrowed because the business was running out of cash. And that's really bad debt. Not bad debt, that is a bad debt. It's a bad reason to borrow money to fund an operating cash shortflow because you're addressing the symptom where actually you need to address the cause. Because if a business is on an ongoing basis not generating cash, if the operating cash flow is negative, then that business has got a problem. Something's wrong. The costs are too high for the revenue that's being generated. So we either have to reduce the costs or increase the revenue, but somehow we've got to get it into balance. We can't continue to trade and borrowing the money only papers over the crack. So it will get you through this month's payroll and probably through next month's payroll, but it won't address the real problem, which is that your operating cash flow is negative, which is why it's one of those sex numbers that you need to know. You need to understand what your rhythm is and where you are at and what your operating cash flow actually is. And again, I recognise the challenges of trying to do this in an environment like this. But hopefully, Jeremy, that makes a little bit of sense to your question there and to the person on the live stream that asked the question.
There's another reason. A business is worth a lot more to an investor or a purchaser if your operating cash flow is positive all the time. Because if it's not, you have to get funding to grow your business. And if you don't need funding and you can grow your business without the funding, then it's far more attractive to an investor or someone who wants to buy your business. And the challenge is when you look at the money in your bank account, most people miss what's in their balance sheet, which says how much you actually owe. How much you owe HMRC, how much you owe other people, loans and so on. So again, your operating cash flow has got to take consideration of all these other things to pay that cash out. So if it doesn't do that, so we've worked with clients who've had $250,000 sat in their bank account. They think, we've got all this money, let's go and spend it. And then a year later or something, Mr. Taxman comes and says, can we have £200,000, please? They go, no, we've spent it. Now, the trouble is with that, obviously, you can't get away from that unless you knew that in the first place. So one of the key things to understand about your cash is also understand, whilst you take out your VAT, because you have to on a quarterly basis, what we advise people to do is also take out cash that you owe in the future, like corp tax cash and everything else as well. Because then you know it's sat in a separate bank account, it's away from you, and it will be paid to them at some point. Remember, it's not your money. You're just the collector for HMRC. So it's really important to understand that.
So, and as I say, operating cash is a thing. It's a real accounting thing. And if you've got if you're on Xero or QuickBooks, it's not a difficult thing to get a little report which tells you every month, well, did we generate cash? Did we not generate cash? But it's all the cash that's gone in or out. The bank account scenario is what Michael Mikhailovich talks about in Profit First. And again, which is something that we follow to quite a large extent, really. So we have our main bank accounts, which everything trades through. And on the first of every month, I sweep money. So our main account that we trade through, the EC main account, on the first of the month, so everything's been paid off at the last of the month, etc. And what I do on the first of the month is we make a transfer, and we first of all we look at what our sales were in the previous month, and then broadly speaking, when we work it through, because obviously with your VAT bill, you're able to obviously reclaim the VAT you've spent as well. But what it means for our business, that in round numbers, what we've deduced over the years is that 13% of our turnover is, broadly speaking, what our VAT bill ends up being every quarter. So on the first of the month, I will take 13% of whatever our sales were the previous month, and I will move that money into the tax account to cover the tax bill. Does that make sense? And then what I also then do is take another 5%, and I put that in there to start to provide for my corporation tax. And there's a reason why I only do 5%, because you can do things like make big pension contributions, which actually reduce your corporation tax and stuff. But so I basically sweep that money out of the main account into our tax account, and I do that. It's the first thing I do on the first of the month. And even if I'm not in the country, even if I'm on holiday, on the first of every month, I will have a conversation with my finance team and we make those transfers. I never delay it. I never let it hang by. It always happens on the morning of the first day of the month. And it's based on what the bank balances were in the main account. So I put the money into the tax account, and then the other bank account I've got then is called a profit account. So having made the transfer to the tax account, what I then do is I then sweep everything. I keep £50,000 as our float in our main account. And then everything, so anything, once I've made the transfer to the tax account, I then sweep anything else that's left in the main account above £50,000, I sweep that into the profit account. So I take it out of the flow. Does that make sense? Because the 50 grand then it's the flow for a business of our size, and that you wouldn't need. Depends how big your business is, but we're reasonable size. But so I need that 50 grand as a kind of, that's our float. But that's what sweeps every month. So I've got 3 bank accounts. There is the main account through which everything is traded. That's where all our bills are paid from. It's where all our income comes into. But then the other 2 accounts, there's only transactions there on the first of every month, and that's how we do it. We move it into the tax account, and then we sweep into the profit account. And then when I look at my bank balance, what I'm looking at then, for me, is the profit account. Because the profit account, that's like my money. That's how I psychologically think about it, because my profit account, that's my money. I can choose to spend that. So I can do what I want to do with that profit account. If I want to we just rewired the whole building, relit all our lights, spent about 10 grand on the lighting, for instance. Now that was fine, because I can do that from the profit account. Does that make sense? Because we've got the money to do it. We've just reinvested in some new kit for our studio, which was quite a lot of money, but that came out of the profit account, because that's where it's money to do from. But I'm confident doing those things because I've got my operating cash flow, and also I can see where the money is, and my tax account has got enough money in it, and that tax account obviously builds up. Then the VAT bill comes in, we pay the VAT bill from the tax account. When the corporation tax bill comes through, there's enough money there to pay it. And broadly speaking, that kind of works. And that makes life just a lot clearer. And when I think about it, that's actually really quite a simple thing to do, but I really would, I recommend it, because if nothing else, it helps with the quality of your sleep as a business. Well, just everything's there. It's simple little jam jars, really. And if you want to understand more about that, because what I do there is that's not a complete iteration of Profit First, but it is a rudimentary implementation of Profit First. And Profit First is the book, as I said, by Michael Mikhailovich, and that's what we look at there. So that's operating cash. So we've looked at gross margin, we looked at break even. That's what operating cash is. So we've done 4 out of our 6 now of the key numbers. The next number then now is cost per acquisition. And this is about acquisition of customers, of new customers. This is the amount you pay and I put in brackets there, or should pay on page 79 to get a new customer. Now, normally here, the way I would recommend you think about this is it includes, when we do this in our business, we include all our external marketing costs, but I do not include my salespeople or the salaries of my marketing team. Does that make sense? So, and I know I've got to employ them to do the stuff, but any money I spend on direct mail or with Facebook or with Google, that all goes into that's where my cost per acquisition is, it's where it all comes from. And the reality of it is that to build a 7-figure business, to build £1 million business, you won't be able to do it by going cheap on your cost per acquisition. So you want to think about, and this is a little bit of homework. I'm sure you've got a few things to think about tonight, but this will be a biggie that we'll pick up on in the morning. Is what is your maximum allowable cost to get a customer? And again, I'm very aware that for a lot of people, you won't have given that any thought, and you won't actually have a particularly robust answer to that question. But if part of your plan is to grow your business, especially if you're going to grow, meaningfully from where you are now, you're going to need to understand this and it's getting harder to acquire customers, by the way. It ain't getting cheaper, even though the opportunities of things we can do are getting higher and getting bigger. You're going to have to spend some money, and understanding what your maximum, I don't need to put maximum allowable cost, you can call it maximum CPA, your maximum cost per acquisition will be a really useful thing to know. And we've seen ours go up, it almost seems like unrelenting, to be honest. So we were in a place 2 or 3 years ago, certainly before COVID, where we didn't have any trouble really getting customers for, in round numbers, £100, which for a business like ours, we were very happy to do. Although it gets interesting when you're spending £100, and right through COVID, we were able to maintain this 110, 120, £130. So it's costing us that to get a customer. But our problem was in our business is that whilst we got the customer at the beginning on day one, having spent the 130 quid, we didn't get any money from the customer until month 4. Because what we were offering throughout the whole of the pandemic was our 3-month bursary. So people could come in for free for 3 months. There still might be 1 or 2 of you here in the room today that are still on the bursary. We've stopped the bursaries now. So we incurred the cost, the 120 quid to get the customer. We incurred that up front. The customer arrived, having cost us £130. We then had to wait 30 days, 60 days, only on day 91, did I get £99 in. And of course, I didn't get that for everybody, because some of the buggers left before they got back to that point. So we weren't actually we weren't back in the black, as it were, until it was actually close to month 6, in truth, because of where we're on retention. We got pretty close to month 5, but we weren't actually making any money till close to month 6. Now that does affect my ability to the rate at which I can grow, because I'm out of pocket for 6 months worth of acquisition. Does that make sense? So if I make just to again show you how you would want to think about this as a professional business person. And I'm making these numbers up now. Let's just keep the maths simple. So let's just assume my cost was £100 of acquisition I'm prepared to go to. And let's just say that I want to bring in 1,000 customers in a month. Then it's going to cost me £100,000. So it's £100,000 it would cost me to bring in 1,000 customers at £100 each. But I'm not going to get that money back. That's going to be liquidated in month 6. Now, I now need £500,000 of cash to maintain that level of acquisition. Does that make sense? Now, it's still a sensible thing to do, and it's very profitable for me, because once these customers get to month 6, they're very sticky. Now, our retention rate beyond month 6 is really, really high. And in month 6, I've liberated all my cost of acquisition, and so I'm now starting to make money. So I really want to do this if I can, but I need £500,000 of cash to fund that rate of acquisition, because I understand how my business model works and what I'm able and capable of spending. Now, those numbers were not quite real, by the way, but they're illustrative of what we're talking about. And my point is that most people in business don't understand those levers in their business, and they don't understand what they should be prepared to spend and what they could do with it. And this is why cost per acquisition is one of the 6 really, really important numbers. And the reason for it, I think I'm just going to skip forward a little bit out to page 82, and I will come back then in a moment or two. But the biggest mistake, I've called it, because it's the number one mistake that most people know but don't do. And it's not about money. The people who've got the money to spend make the same mistake. It's a mental mistake that has to be fixed, because they try and get their leads and their customers and their clients as cheaply as they can. That becomes their mission. They're easily attracted to what looks like the cheapest thing to do. And it's stupid, because it deprives you of the number one advantage that you could ever have in any business, in any industry, which is to create a scenario where you can spend more than all your competitors. Because if you can spend more than all your competitors in a market to acquire customers, and you can spend that commercially viably, then you can dominate that market, because they won't come close to you. So then, and that's how you get to your £1 million or your £10 million business really, really easily. But if you don't understand these levers, you never get there. And when you go cheap on customer acquisition, it limits what you can do. So you can only, you can have a little trial and have a little dabble on Facebook ads, but you can never get properly good at it. You don't send direct mail. If you send direct mail, you send shitty little direct mail that gets put in the bin, rather than eye-catching, memorable direct mail that gets actions. And in page 82, the second half, by changing your strategy and getting the economics right, you can buy speed, you can buy growth. And smart marketers will look to find ways, to do that and make that happen. And whereas the 1% will ask how they can do it more expensively and what they could do to force people to read stuff, whereas 99% will look to save money and go as cheap as they possibly can. And when you have that approach, and often it's just an instinctive approach, it's not something that you've thought about consciously. It's just, this is back to why £1 million business owners are abnormal, because we think about things differently to the majority. And most people in your sector or industry, whatever sector or industry you're in, I know that most people in that industry think about getting customers from I'll spend as little as I can. And that's fine for a lifestyle business. But that is it's a very flawed strategy if you're trying to build a big business, if you're trying to build a £1 million business, so that's all linked into the CPA piece on page 82. So I just flick back, and I'm just looking at where I'm at now in terms of anything you want to add to those bits.
I think the key thing is, if you understand your terms, and then you say those terms say you need to generate like 100,000 profit, and then your business is delivering exactly what you want for your lifestyle and your families, and you convert that to the number of customers you need, and you know how much it costs to get a customer, don't you think that's so simple? To then turn around and say, well, actually, I just need to spend 100 customers, 1,000. I need to spend £100,000, get that right, and I have a business for life that generates what I need for me and my family. I just think that's so liberating. And that's what we try and get with the mass market customers everywhere. We try and say, what is that number at the top? How many customers do you need? How much are you going to spend? Let's go and do it. And that's such a relief when you can get that in your business, when you understand it.
So there's a big question on page 81 for you to think about this evening. It's and it definitely needs a bit of thought, does this? How much would you spend to get a new customer in your business? And again, I recognise here that, customers are different, because some spend a lot of money and some spend a little, but there's always an average. There's, you know your business, you know your customer base. When we bring people into EC, what happens is some people don't stay very, some don't pay anything at all. They leave before they've even made the first payment. Others stay as standard members for a period of time, but some come in and will quite rapidly go up. They want to spend more money with us. They want some coaching help or support. They want to join Master and other things. So there's an average. I can map it all out. We've been doing it long enough to understand what actually happens, and you can do the same. And thinking then around the big question at page 81 is the one at the top. How much would you spend to get a new customer? And if you want to work it out, then there's the little tool to work it out is on page 83, which is out. Those of you that have worked through the entrepreneur's marketing and sales system will recognise that. That little tool is in the EMS on the EC Vault.
It's pretty self-explanatory. Essentially, it is the manifestation of what Martin just talked about, is how that budget calculator works through. But that's how professional business people think about their customer acquisition, and that's why the CPA number is really key. Just to complete the story, by the way, we're now we're getting now much closer to £200 to get a customer. Which is a result of all sorts of things, and it's results of what's happening in the marketplace and where we're at in the kind of economic cycle. It was easier for us to get customers in the pandemic because when in times of uncertainty, more businesses tend to look for the help that we provide, which is but it's given us. They're challenges, but they're good. We're dealing with them, but it forced us to, we have to look at things a little bit differently because, we're not at £200 yet, but we're closer to £200 than we are to £100 now, and that's not something I'm going to be able to reverse in the short term. So we have to think a bit differently about it. It's not a difficult thing to do things in our business to be able to respond and to cope with that.
But that's a classic example. Was if you didn't know your numbers and you weren't measuring it. And suddenly the price went up to the acquisition, and then that means obviously your profit is now going to drop. Then suddenly your business isn't generating what you want, and everything changes. And that's why on a monthly basis you need to understand these things. So when the market changes or something happens, you can adjust what you do and how you do it to make sure you deliver back your terms again.
So I think what we'll do, I'm going to stop now. The other little one to what's the word? Anyway, the one. Think about tonight is the one on page 84. I've framed it as what the big question that seven-figure entrepreneurs ask themselves. What can I do to my business that will allow me to change the economics of getting a customer? What would allow me to spend more money to acquire the right customers, the right people? And there's not an easy answer to that question, but that's a good quality question to answer and to give some thought about.